Very good morning, friends. Today we are going to have the fourth session on the subject MMPC 004 Accounting for Managers. I am ASEEM Kumar. I am the resource person for this particular course. Friends, up to 30th April, we have covered the following topics in Block 1, titled Accounting and Overview. We have discussed about the introduction to accounting, preparation of books of accounting, financial statements, preparation of financial accounts of companies, cash flow statement, and then in block 2, which had a title of cost accounting, we have discussed understanding and classifying cost, absorption and marginal costing, and finally unit number 8, activity-based counting, activity-based costing. Friends, today we are going to cover the block 3, which has a title of application of cost accounting. We are going to discuss unit number 9 on cost volume profit analysis, unit number 10, budgeting and budgetary control, unit number 11, variance analysis. Let us just understand what is CVP analysis. The full form of CVP is the cost volume profit analysis. It is an attempt to measure the effect of changes in volume, cost, price, and products mix on profits. Now, you will appreciate that while these variables are interrelated, each one of them in turn is affected by a number of internal and external factors. Thereby, whether we talk about the volume, whether we talk about the cost, whether we talk about the price, whether we talk about the product mix, every component of CVP having number of other internal and external factors which are affecting it. For instance, cost vary due to choice of land, scale of operations, technology, the efficiency of workforce, and management efficiency, etc. Now, when we are just talking about the overall cost, whether it is cost of production or cost of sales, if we just speak about the factory cost, the choice of plant, the scale of operation, the technology we are using, and the efficiency of the workforce is of paramount importance. And once we just get to know about the reason behind the efficiency in the cost of sales, we add up the factor of management efficiency as well. Also, the cost of inputs bought externally is affected by market forces. Now, somewhere or the else, right now we were just talking about the internal factor, but we have certain external factor as well, which are affecting these components to a greater lot. While many wide-ranging factors influence cost and profits, the largest single variable affecting them in the short run is the volume of output. The volume of output, because the output which is just leading to the placement of it at the sale counter. So the volume of output is again a paramount factor which is just helping us to know about that whether we are producing more whether we are producing at par with the earlier months or whether we have increased our output. Hence, the CVP relationship acquires a vital significance for the manager facing a wide spectrum of short-term decisions. Like when we are just talking about the CVP relationship amongst the components, we need to know about certain short-term decisions also. We need to just face all those wide spectrum of the short-term decisions as well. Like what are the most profitable and what are the least profitable product. Friends, once we are in know of it that this product is profitable and it is earning the maximum profit, definitely we would like to continue it. But in case our profits are not coming out to be on the best in some of the product, we may like to just review the technology, the efficiency of the workforce, the quality of the raw material, or to discontinue it for some time as a stopgap arrangement. Second decision would be how does a reduction in selling price affect profits? Friends, we always know about that the profits are selling price minus the cost of sale. Selling price minus cost of sale. But once we are just reducing the selling price, definitely we will be having the reduction in the profit on an average. But it may so possible that we are having the reduction in the cost as well. Therefore, your profits would be stagnant. Your profit may be on the increasing side. So it depends how good monitor you are. Our next decision would be how does volume or product mix affect product cost and profits? Friends, if we are just talking about a very small sample or very small quantum of volume of work, definitely it is just taking the primitive time at the time of its production. But once we are having a bigger volume, once we are having the say product mix, definitely in both the cases we will be having the product cost and profits in a different node. It is very important to know about whether we have any losses. So just to know about whether we have any losses, we need to know about what will be the break-even point if volume and cost change. Why, friends, we need to know about the break-even point? Because it is the point where our profits are zero. Our selling price and cost are equal. No profit, no loss. So we need to know about what would be the break-even point if the volume and cost change, so that at least if we are earning profit, okay. If not, we should not get down from break-even point. How will an increase in wages or other operating expenses affect profit? Friends, apart from material, the wages are the other paramount or important or the vital organ of the product. Therefore, if suppose there is an increase in the wages or other operating expenses, we need to concentrate on the other expenses, whether we have reduced them. If not, definitely our profits would be affected. Our next decision would be in the short run, what will be the effect of plant expansion on cost, profit, and volume of sales. Friends, definitely once we are having a new plant or machinery or technology, definitely our cost would be reduced. Our volume of production shall be on the rise. Simultaneously, if we are just taking the monitoring mechanism in a sound manner, then our profits would also be affected and it could be on the rise. Answers to all such questions will have to be formulated in a cost benefit framework, and CVP analysis will offer the technique for doing it. Once you are in a position to know what the answer for all these questions, you will be knowing about that where you are having the cost benefit, where you are having the stagnation, or where you are having the cost increase. So that at least the overall cost does not get affected and your profit too. So CVP analysis, it offers the technique for doing so. Friends, once we are in know of the cost, volume, profits, we have to just look at the cost segregation part as well. In the cost accounting block 2, we have discussed that we are having the cost in two parts. One is the fixed cost, the other one is the variable cost. But invariably we can have the third category also. It could be a mixed category. It could neither belong neatly to the category A or B. It may be, if it is in the proportion, better proportion of the output of volume, then it is variable cost. And if it is mixed cost is predominantly fixed, then it would be a fixed cost. So let us just understand in detail. Some broad guidelines may be suggested to divide cost into two dominant groups with fixed and variable. They are listed below. Cost that remain invariant to the volume of activity would be considered fixed. No costs are fixed forever. The concept is relative to the planning horizon, usually a short run one, and the relevant range of activity. So, if there is no change, there is no variation in the cost with the volume of activity, it would be fixed cost. But the cost that vary in direct proportion to the volume of activity will be classified as variable cost. Now, what is variable cost? Suppose we are having 10 units, and once we are just adding in the volume of activity, the 11th unit, in the proportion of our cost we have incurred for the 10th, the increase in the cost would be there at the production of the 11th unit as well. Thereby, every increase in the volume of activity would be seeing the increase in the variable cost. And the third category, which we have already seen in the introductory part, cost that otherwise belong to a mixed category, which neither belong to neatly to category A nor to category B above, would in fact be apportioned to one of the two categories, fixed or variable. If a mixed cost varies in some proportion to output or volume of activity, it will be classified, it will be classed as a variable cost. On the other hand, if the mixed cost is predominantly fixed, it would be classed as a fixed cost. That means if the mixed cost varies with the volume of activity, increase or decrease, it would be a variable cost. But if predominantly fixed on the change of the activity, it would be a fixed cost. So we can reclassify this mixed category to either of the variable cost or the fixed cost. Marginal cost and contribution. Once the fixed and variable costs are segregated, it becomes possible to calculate the total contribution as well as total contribution per unit. How we calculate the contribution? You will recall the total contribution equals the difference between sales and marginal within bracket and variable cost. So that means once we are reducing the variable cost out of the sales, we will be able to get the total contribution. And if we divide by the volume of output, it would become the total contribution per unit. The total contribution per unit is expressed in per unit terms by dividing both sales and variable cost by the total number of units and deducting per unit variable cost from per unit selling price. That means first we will be getting the variable cost per unit, second we will be getting sales per unit, and then we will get the difference of these two. The contribution would be arrived at per unit by having the difference of these two. So the total contribution may directly divided by the total number of units by arriving at similar results, that is contribution per unit. We should remember that total contribution is the contribution of sales revenue to fixed cost recovery and profit after meeting the total variable cost. It means the total contribution is contribution of sales revenue to fixed cost and profit. That means the contribution is mixture of fixed cost and profit, because as of now we have only reduced the variable cost. So once we reduce the variable cost, we come to know about the contribution, and once out of the contribution we reduce the fixed cost, we get the profits on the given sale. Just now we have discussed that we have to care about the break-even point in the event we are having the change in the volume, change in the activity, the production increase or decrease, because then we get to know what there is no profit, no loss, so that at least we can monitor and give some more efforts to get the margin of safety, to get the profits, to get the pluses. So break-even point, at this point total cost and total revenue are held in equilibrium. The total cost and total revenue are equal, and a no profit, no loss position emerges. Once we reach to a place when there is no profit, no loss, that means it is the safest position we have. Once we are having anything which is just increasing in the cost and reducing the revenue, it will start incurring the losses. So break-even point is the safest place for a business to think about the monitoring and cost of output. So once we get to know about this particular position and once we implement it, we reach to the margin of safety. So margin of safety is obtained by deducting the break-even sales from the planned sales. Now, if the sale is more and planned sale is less, that means we have the safety in plus side. It is not the safety at zero level, but the safety at plus side. But if suppose our sales is less than the planned sales, that is the break-even sales, then we are incurring the losses possibly. Permutation combination applies. Friends, with that we have completed unit number 9, and now we are moving on to the next very important factor of an organization, that is budgeting and budgetary control. Friends, once you just start planning, all the components are to be planned, whether it is HR, whether it is operational, whether it is marketing, and whether it is financial. Financial planning is of vital importance. Why? Because unless the financial planning is strong, you will not be able to just cater to the marketing, you will not be able to cater to the operations, you will not be able to cater to the HR. So therefore, the financial planning should be strong. Though these are interconnected, yet the finances are playing the lifeblood of the organizational body. So financial planning is concerned with the raising of funds and their effective utilization to maximize the company's wealth. Once we plan for finances, we need to know about where from we will be having the funds and where we are going to utilize it. What kind of funds we are going to raise and what kind of expenditure we are going to incur, so that we can maximize the company's wealth. It includes the determination of the amount of funds needed for implementation, various business plans. The funds needed, it could be short-term funds, it could be long-term funds, it could be medium-term funds. Once you are having the long-term plan, definitely the funds would also be needed for the longer term. The pattern of financing, where, how, and why you are going to finance your funds. The form and proportion of various corporate securities such as shares, debentures, bonds, bank loans to be issued or raised. How you will get financed. Okay. Again, we are just talking about whether it is short term, when it is just coming out to be the bonds, short-term bonds, bank loans, short-term loans. But when we are just talking about the long-term loans, bonds, debentures and shares, these are long-term funds which we are just raising for implementation of our various business plans. The timing of flotation of various corporate securities. How, when, why we are going to float various corporate securities, whether the bank loan raising would be beneficial, or we have to issue the debentures, or we have to issue the shares. It depends on your planning and strategy. Despite a sound financial plan, the desired result may not be achieved if there is no effective control. Now this is important. You may plan it, but if you don't monitor adequately, if you don't make the control mechanism implemented, then it would be faulty. Okay, the result may vary. It may be very less, it may be mediocre, or it may be very good. But very good quotient would be very less. Why? Because the effective control to ensure its implementation is not there. If it is not, it would be at the mediocre level or at the marginal increase. The budget represents a set of yardsticks or guidelines for use in controlling an organization internal operation. See, once we are just forming or we are floating or we are preparing the budget, we are putting a set of yardsticks that this is your limit, these are your parameters under which you are to spend the organizational funds. What is budget? A budget is a plan expressed in quantitative, usually monetary terms. At par with the accounting norms, unless the budget is given in the monetary terms, it will not be called the financial budget. Covering a specific period of time, say the accounting year, one full year, usually 1 year. In other words, see, 1 year would be that if suppose you are the continuing organization, if suppose it is the first year and you have started in May, definitely this year's budget would be of 11 months. In other words, a budget is a systematic plan for the utilization of workforce, material sources. In a business organization, a budget represents an estimate of future cost and revenues. Now, what I said that you have to plan about your revenues, how much you are going to earn, how much funds you are going to raise, short term or long term, and how much cost you are going to incur so that at least you can think of your profits as well. Budgets may be divided into two basic classes, capital budgets and operating budgets. Capital budgets are directed towards the proposed expenditure for the new projects and often require special financing because the capital budgets we are not doing it every day. We are operating part are being catered for our day-to-day expenses, day-to-day working. But capital expenditure, the capital budgets, these are done on occasional circumstances with the occasional timings, and therefore you have to know about how much you are going to finance from the internal sources or from the external sources. The operating budgets are directed towards achieving short-term operational goals of the organization. That means our operating budget are for the short-term or day-to-day operational goals of the organization. The main characteristics of a budget are now how the budget looks like. What are the parameters? What are the basic points in the budget? It is prepared in advance and is derived from the long-term strategy of the organization. दोबारा तो नहीं करना, वहीं से स्टार्ट करें। देख लीजिए स्टार्ट कराऊं फ्रेश तो लाइट गई है तो थोड़ा sorry for the interruption, it was a technical glitch. We are resuming with unit 10 on the topic budgeting and budgetary control. We have already discussed about the financial planning and the budget. Before the technical glitch crept in, we were discussing about the main characteristics of a budget. It is prepared in advance and is derived from the long-term strategy of the organization. Why we are preparing is this particular component or this particular statement or this particular document in advance, because it is a financial planning. And unless we prepare in advance, we will not be able to communicate our functionaries that how, when, and what are the limitations or what are the parameters they have to spend in the next year. And it is derived from the long-term strategy of the organization. An organization is always willing to serve for a longer period, precisely for the indefinite period. So that 1 year, how you are going to perform is being prepared in advance and communicated to the functionaries. It relates to the future period for which objectives or goals have been laid down. Definitely once we are in 2023-24, we may be having certain objectives or goals which we might have set for 24-25. For the financial year 24-25, we need to set the objectives or goals much earlier, that is in 23-24 only. And that is why we prepare the budget, because it relates to the future period for which objectives or goals have already been laid down. Now, once we have the objectives or goals, we need to just support it with the financials called budget. It is expressed in quantitative form, physical or monitoring unit, or both. Now, there is a small change from the quantitative form, physical or monitor, or both. You see, we know about that it may be in the quantitative form as well at a later advanced stage. But initially we have to prepare the monitoring units. The monetary units are in the terms of financial planning. How a budget is useful? It brings about efficiency and improvement in the working of the organization. Once you are in know of the factor that this is your future plan, how you are going to make it, you get to know what, and then you are already prepared. So this increases your efficiency and improvement in the working. It is a way of communicating the plans to various units of the organization. You see, when you are preparing the financial plans, you are communicating to the concerned unit, and those divisional, departmental, sectional budgets, exact responsibilities are assigned. It does minimize the possibilities of bug passing if the budget figures are not met. So once you are informed well in advance that this is your parameter and these are your limits on the divisional level, departmental level, sectional level, they cannot pass the buck saying so that they were not known to. If suppose their goals are not met. It is a way of motivating managers to achieve the goals set for the units. Set for the units. You see, once you are in know of that this is your target, definitely everybody is used to, they are tuned to achieve those goals, targets, and therefore there is a motivational force once these are given to you. It serves as a benchmark for controlling ongoing operations. See, once the target is fixed, it is a benchmark. It should not be less, otherwise you will be termed as the deficient worker or the worker with lesser capability. So the benchmark is set for you for controlling the ongoing operation. You can always motivate you and then achieve those benchmark, complete those benchmark by doing your best in your ongoing operations. It helps in developing a team spirit. Now, the individual goals are there. Simultaneously, we are having the team goals as well. So the team, like a cricket, hockey, or a football team, though the individual players, they are having their individual role and the vital organ they are becoming, however, their team spirit also matters a lot. So with the budgeting, they are to make out, they have to achieve, complete their individual benchmark as well as the sectional, divisional, or their units benchmark as well. It helps in reducing wastage, losses by revealing them in time for corrective action. Now, once we are having a budget of 1 lakh rupee, so with 1 lakh rupees, definitely we will be having something around 8,300 for a particular month. In case we are incurring more, that means we have some wastage. We have certain, if it is not supported by the volume of output, definitely it is a wastage or the losses you are incurring. So it helps you to reduce the wastage and losses by giving you the corrective action in time. It serves as a basis for evaluating the performance of managers. Once you are motivated, once you achieve and complete the benchmark, definitely you are at an edge above. So that performance is only because of the in advance information with them, the timely benchmark achieved by them, and with the consistency of motivation in their work. It serves as a means of educating the managers. You keep on getting the information. You are educated that this much is left, this much you are to spend, this much you are to control, This much you are to do in your balanced time. So once you are well educated at the manager level, you will be in a position to monitor or control also effectively. We are now reaching to the other topic, that is budgetary control. Why do we need budgetary control? The process of budgetary control includes preparation of various budgets, continuous comparison of actual performance and budgetary performance. Once you prepare the budget, it is well in advance. Now, at the start of your financial year or accounting period, you now compare the actual performance with the budgetary performance. Okay? Revision of budget in the light of the changed circumstances. You may be having certain changed circumstances. You may be having certain other orders. You may be having certain other goals which are added during the year. So you can revise the budget also if need be. Friends, installing a budgetary control system is very, very important. Unless there is a proper system of budgetary control, you may be having the operations haywire. You may be having the losses. You may be having certain deficiencies. The time deficiency, efficiency bar are not achieved. The operations are lagging behind, and so on. So having understood the meaning and significance of budgetary control in an organization, it will be useful to know how a budgetary control system can be installed. This requires, first of all, finding answers to the following question in the context of an organization. What is likely to happen? What is your plan? What can be made to happen? If you can make some benchmarks, some efforts, so you can make it happen also. What are the objectives to be achieved? Given you well in advance. It should be just the light of those objectives should be there with you all the time. What are the constraints, the loopholes or the roadblocks, and to what extent their effects can be minimized? See, whenever you start working, like today we had a sort of power failure and there was a technical glitch for a fraction of a second. It led to a small but a deficient time lag for about 3 to 5 minutes. So this was one of the constraints, but with the able effort of our regional center staff, they could come out of it and they have minimized this particular effect. The constraint is over within 3 to 5 minutes. So if you have the answer for all these questions, the following steps may be taken to install an effective budgetary control system in an organization. Organization for budgeting, you need to know which organization you are budgeting for. You have to fix up the responsibility for budgeting also, whether it is section, unit, divisional, or the overall responsibility of the budgeting. Yes, the CEO would be having the responsibility for the entire organization, but again, these are decentralized at different level. There would be a person who would be called budget controller, who would be having a monitoring activity, looking at okay, how much budget you have, how much you are going to spend, how much you are spending, how much is left. Friends, when we prepare the budget, there is a committee. There are different people who are forming a budget committee and who are giving you the information that what is the overall plan of a particular stream, whether it is HR, whether it is operational, whether it is marketing or the financials. They are giving an overall picture of their selected stream, and thereby they are constituting an overall budget in the committee, who are just placing it before their board for approval and the consideration and approval. Fixation of the budget period, normally it is accounting year, but as I told you, if suppose you are starting your business in the month of May, then definitely your fixation of budget period will be 11 months. Budget procedure. You get to know about, you get the estimate from different sections, units, divisions, and then you start compiling it. The key factor, you must know about what are the key factors in each budgetary procedure. Making a forecast. It is the advanced financial planning, therefore is called a forecast. You are giving a small document which is forecasting that you are going to have this much of revenue in the coming financial year and this much application of those funds. Preparing budget of different units, divisions, and choice between fixed and flexible budgets. You may be having a flexible budget in normal cases, but for something you may be having the fixed budget, like for the technology, machinery, and other fundraising things. You cannot afford to just go for a sort of very, very flexible in fixed budget. So always there will be a mixture of fixed and flexible budget in an overall statement of budget for a financial year. Classification of budget. Here we have the budget can be classified into different categories on the basis of time, function, or flexibility. The different budgets covered under each category are shown in the following chart. If you just look at the time factor, in the time it is long term, it could be for a longer time, it could be for a shorter period, it could be concurrent, or it could be rolling. But if suppose we go for the functional part is the operational part we are just talking about. It speaks about the sales budget, the production budget, the overall production, maybe of very, say, big number of product series we have, cost of production of each unit, purchase budget, personal budget, research and development budget, capital expenditure budget, cash budget, and master budget. Friends, master budget includes the entire functionality of the organization, be it sales, production, purchase, research, capital, cash. All the domains are covered in the master budget. But once we are having the flexibility as the basis, then we would be having two kind of budgetary provisions. One is fixed budgetary provision, the other one is flexible budget provisions. Sometimes we need to control certain budgetary provisions also. We need to know what is our activity. Is it coming out to be on the plus side, efficient, or otherwise? What is our capacity and how we can just calculate them. So the activity ratio is a measure of level of activity attained over a period of time. It is obtained by expressing the number of standard hours equivalent to the work produced as a percentage of budgeted hour. Now standard hours for actual production, budgeted hours. Okay. You just get to know what this much activity you are supposed to go for. If you say capacity ratio, the ratio indicates whether and to what extent budgeted hours of activity are actually utilized. Now here comes the working one. Here you are just reaching to a destination. It shows the relationship between the actual number of working hours and the maximum possible number of working hours in a budgeted period. So the actual hours worked divided by budgeted hours multiplied by 100. Similarly, the efficiency ratio, once you get to know what this ratio indicates the degree of efficiency attained in production, it is obtained by expressing the standard hours equivalent to the work produced as a percentage of the actual work spent in producing that work. So the standard hours for actual production and actual hours worked multiplied by 100, it is called the efficiency ratio. Performance budget. Performance budget or the program budgeting has been designed to correct the shortcomings of the traditional budgeting by emphasizing management's consideration approaches. Both the financial and physical aspects are incorporated into the budget. I told you little earlier that the performance budget presents the operations of an organization in terms of its functions, programs, activities, and projects. It is both physical and financial aspects are included therein. In performance budgeting, precise detailment of job to be performed or services to be rendered is done. Secondly, the budget is prepared in terms of functional categories, their subdivision into programs, activities, and projects. Thirdly, the budget becomes a comprehensive document. Since the financial and physical results are interwoven, it facilitates the management control. The main objectives of performance budget are to coordinate the physical financial aspects, to improve the budget formulation, review, and decision making at all levels of management, to facilitate better appreciation and review by controlling authorities, legislature, board of trustees, or governors, as the presentation is more purposeful and intelligible. To make more effective performance audit possible, to measure progress towards long-term objectives which are envisaged in a development program. Thereby, now the performance budgeting involves the evaluation of performance of the organization in the context of both specific as well as overall objective of the organization. It presupposes a crystal clear perception of organizational objectives in general and short-term business objective as stipulated in the budget, in particular by each employee of the organization, irrespective of his level. It thus provides a definite direction to each employee and also a control mechanism to higher management. Friends, it requires the preparation of periodic performance reports. We compare the budget and actual data and show the variance. We are facilitating the management by saying so where we are improving or where we are reducing, where we are decreasing. The detailed workout of variances are giving you the insight of your functional efficiency. Friends, with that, our time is over for today's lecture. We will start with zero budgeting in the next session. Thank you so much. Namaskar. बीच में तो वो भी आ गया था भाई,